Hi everyone, welcome to the Mills Team webinar. My name's Katie Mills, and I'm joined today by two of our teammates, Michael Adams and Christine Sweeney, and we have a special guest today, one of our trusted mortgage brokers, Sean Humphries from Dominion Lending Center's Edge Financial. So we're going to talk to you a little bit today about what's happening in the real estate market as well as in the mortgage market. There are lots of headlines. We find ourselves here in the middle of 2022, and it feels like a bit of a roller coaster. So we want to kind of demystify a little bit of that today. We're seeing lots of headlines regarding inflation and the Bank of Canada and interest rates, mortgages. A lot of it comes down to supply and demand, but we just want to chat about all of those things today. So welcome, Sean.
Thank you.
And Christine, maybe you can get us started with our first question for Sean.
Yes, so obviously we're all hearing a lot about Bank of Canada and rising interest rates. We're still expecting 3 more interest rate announcements before the end of the year. Mm-hmm. And some people might be thinking that an interest rate hike with the Bank of Canada means that their mortgage rate is also going to go up by the same amount. Mm-hmm. Can you just explain a little bit how that all kind of works together and what factors play into that?
Yeah, we've had quite a few, we've had a massive run up in interest rates this year. I mean, in the last 4 months, we've gone up 2.25%. I mean, with the Bank of Canada increasing their overnight lending rate, their policy rate, that immediately affects the variable rates. So people who are on a variable rate right now have seen their interest rate increase 2.25%. And as of earlier in July, we had an interest rate increase of 1%, all in one go at that time. And so the Bank of Canada is, what their words were, is they're front loading an interest rate hike. So instead of it being maybe, kind of what we're used to before is a quarter point at a time and kind of edge it up or edge it down, they went full Monty 1% increase at that time. And so, that they're trying to really shock the market, and they're trying to bring the interest rates up 1% at that time and front load it. So rather than doing little interest rate increases kind of a little at a time, they're just trying to rip the Band-Aid off and get it done.
Right.
So we're expecting in September that we'll have another jumbo size interest rate increase of probably, the prediction is another 0.75% at that time. And then for the bank to sit back and sort of watch it all burn, essentially. Let's see what happens. They are trying, they let it settle in. They're trying to slow down the economy right now and bring inflation down. We just had another announcement that we're 8.1% in June, which is the highest it's been since 1983. So, the good news is we're starting to see some of the underlying numbers start to come down. The price of oil is coming down. The price of food is coming down. So some of the things that are causing inflation to happen, we're already seeing some relief in that, but that's not reflected in the June inflation numbers.
Right.
So I think people can expect higher interest rates on their variables. Fixed rates are probably where they're as high as they're gonna get, in my opinion.
And I guess the good thing is that Bank of Canada is being quite transparent about what they're trying to do, which sort of takes some of the uncertainty out of it, which is helpful in a way.
Yeah, they're saying that more interest rate increases are needed. We're trying to bring down inflation. They're being, they realize they made a mistake by probably lowering it so much to begin with, and then keeping it low for such a long period of time that they need to take drastic measures. And they're being pretty forthcoming about that now.
Awesome. And in today's sort of market, after what you explained, are you sort of advising clients to have, where do you sort of stand, fixed or variable?
Yeah, I mean, I'm all about variable right now. I think, before, a year and a half ago or 2 years ago, maybe you could get 2% on a fixed rate. That was well below what the 5-year average was at that time.
Right.
Now, 5-year fixed rates are all above 5%, somewhere around 90% higher than what people are used to, right? They're used to them being around 3%. So when they're at, 5, locking in at that amount, you're locking in for a long period of time at something that is above average.
Right.
And so, yes, variable is going to move. You're going to start off with a lower rate. It is going to go up. It probably doesn't touch where the fixed rates are now, but it's going to be a bit of a roller coaster. And you probably just need to take some deep breaths as you're as the Bank of Canada makes their announcements.
But ride that out, I guess, for the shorter term as opposed to locking in at a higher rate.
But you're essentially you'd be getting on the variable roller coaster kind of close to the top of where it probably will be over the next 5 years, even though it will raise again this year.
Interesting.
So the demand for real estate is still strong, but as expected, sales volumes are, of course, down from last year. And we find that, in general, as there's times of uncertainty, people tend to take decisions slower, pause and wait. What are you seeing, though? Are you seeing that people are still looking for pre-approval and closing transactions?
The transactions for sure closing. I think anything that we were qualifying before, that's going through. Anything that's qualified in the pipeline is closing as you would expect. Right. The lenders are not going back and, let's take another look at this and use the new rules. They want to close the mortgages. Yeah. They're not having to get the insurers to take another look at it. Everything is moving forward. But I think you're right. Like there's a little bit of fear in the market, which is creating some longer lasting supply, but it's an amazing buying opportunity for people to get out and, what Chris Lightham says, get a screaming deal. Like there are opportunities to, and what I say is like, it's a little bit more of a sophisticated environment. You just don't have to be the first one showing up with the biggest bag of money. Yeah. You can show up and, negotiate, which we haven't seen in a while.
Yeah.
And it won't last forever. So get it while it's good.
Yeah.
Right.
And as you say, if you're ready to go, then when that opportunity presents itself, you're set. You're not then scrambling to get your financing in order.
And depending on the neighborhood, the price might not have changed that much, but the demand isn't as strong.
For sure. No.
You get a good opportunity to get probably above average property in that case.
Right. And I mean, the more supportive thing, the market is still somewhat moving. Like people sort of kind of forecasting that it's definitely dropping significantly, but we've definitely seen a lot of things still move quite quickly. It really does depend on what you're selling and where you are selling. It's super interesting.
So I think it would be great if you could give us kind of a concrete example of when we hear that interest rates go up. What does that translate to in terms of a dollar figure? Because those higher rates do have a downward pressure on prices, and I think it'd be really cool to look at how that all interplays.
Yeah, I mean, for a quarter point increase, you're looking at, which is like the most common thing that happens. Anything that's happened recently is kind of out of the ordinary. But for a quarter point increase, you're looking at $13 per month for every $100,000 of mortgage money. So, as that's been going up, and we've, had pretty significant increases recently, but we're looking at $65 for every $100,000 in mortgage money for that 1% increase. I don't expect that we'll see something as drastic as that again soon, but that's what people are looking at.
Okay, so it makes sense that there's some downward pressure on prices because people have typically a set amount that they can afford per month. Right. And
I mean, like, the average price has gone down like $188,000 in the GTA. People can still afford to buy the average home, even though that price has gone down $188,000. The same income is going to buy that home. So the price in February, you could qualify for that. The price has come down, you still qualify for that same amount, even though per month it's going to cost you a little bit more.
Right. And then I guess the silver lining is that it'll cost you a bit more per month, but that grand total you're paying back is less.
For sure. You got it on sale, essentially. Right.
That's good.
It's still the same house. So you got a deal.
That's a great way to look at it, for sure.
So I think, one of the other examples was like, how much does $5,000 per month buy you, right? Like how much mortgage is that? It's roughly $1 million. So, if, depending on the amortization, depending on the product of the mortgage and the interest rate, roughly $5,000 per month is $1 million mortgage. Okay. Yeah, for longer amortization, 30-year
well, it's great
amortization.
to talk to someone like you because I think people just get scared. They hear about the increases and they don't really know what it means, so it's really helpful to hear those kind of numbers.
Definitely. Happy to help.
We're definitely seeing a lot of change since what we saw January, February, the true height of the market. And, a lot of people like you had mentioned earlier, are kind of freaking out, saying the market is on its way down. But if you actually look at it historically, it is actually still up. We were just at such a height. So, and to your point, essentially the government is just trying to fight inflation aggressively. So, where do you sort of see the mortgage rates sort of going in the next year? Do you have sort of like an idea of where that might take us, or?
I mean, certainly it's a bit foggy. I think that our fixed rates are as high as they're going to get right now. The mortgage rates are based on bond yields and the price of kind of that investment class. And those have been coming down since they're high in June. So the mortgage rates have not come down. They're kind of like, I don't know if they're collecting profit right now, but they're maybe just insulating themselves against any sort of risk that maybe it might go up again.
Right.
So there is some room for them to come down. So I do believe that fixed rates have hit their peak, because essentially the fixed rates are just like a prediction of where the variable rate might go.
Right.
And they believe the variable rate still has room to go up. And there's some unknown in how much it might go up. You know, the prediction or the thinking is another 0.75% on there, but that will still be below what the fixed rates are today.
Right.
And then I think that anytime we've seen a massive increase on the policy rates, shortly after that has been a recession, and they've had to reduce rates after that.
Right.
So they're actively trying to take the wind of the sails of the economy. I know people hear 1983 and they hear early 80s, and you start thinking of high inflation and then high interest rates into the double digits. That's not where we're going now. We're not expecting rates to rise that much. But they need to be high. We need to break the back of inflation as soon as possible to get the economy back under control. And then after that, we'll see the slide down to much more normal 3.5% range. Would be my guess. We'll see, maybe not in a year, but probably in 2 years.
Nice. Okay.
Interesting.
Well, thank you so much for joining us today.
You're welcome.
You're a wealth of knowledge, and I think the main thing is that there are some great opportunities today, and I think, we just want you guys to know that we're all here for you. I also wanted to say that you're doing a first-time homebuyer seminar in August online, so if anybody's interested in that, please let us know, and we can send out the link so that you can join that. I've heard you do them before, and they're awesome.
Oh, thank you. Yeah, they're a lot of fun.
Yeah, so that'll be August 24th, I think, is
August 24th. Mike did one with me.
That's
one
right.
time.
Yeah, that's right.
Yeah, we had a good time.
So that'll be good. So anyway, we're happy to send that along to anyone if they're interested. And I think the message to me today is just not to panic.
Yeah, don't panic.
We're in a time of change,
Yeah.
but that's all the more important reason to get some great advice and navigate through that. There are some amazing opportunities, and we really appreciate you talking to us today.
Anytime. It was fun.
Thanks very much.
having us.
Okay.
Thanks.
Bye-bye.